Blair, take us through your business, at least the way I think your business, the business of deals. When you've been on before, you've predicted that actually this year we would start to see those deals come back after a sort of a quiescent period. Are we seeing it?
So it has come back a bit, and not just deals, but financings as well. But it is by no means where it will be, I think, in 25. There's still been a lot of uncertainty for my world in terms of the interest rate environment, in terms of the election and what that would lead to. Things always, the last quarter, the last 6 months before an election, always people settle down and want to see what's going to happen. Momentum in the economy and regulatory aspects. So it has been a market where companies are still highly focused on M&A, but I would say more highly focused, David, on M&A that is more tactical rather than large, 10 billion, 20 billion above, transformational. I think what you need for that, which I do believe will be coming, is one, interest rates to come down. Remember, the last 4 cycles we've had interest rate declines. After the first interest rate cut, growth has been on average 3% GDP. The markets on average have been up 20%. It becomes a tailwind. It is less relevant whether rates come down over 18 months under 50 basis points versus 100. It's the trend, and it encourages investment from companies, whether it's in their own business, making 10-year bets, or buying a business. And if they believe that they're in the right part of the curve, they are more willing to make strategic 10-year bets in their investment. So I think you'll see a lot of that. I think you'll also see a lot of pent-up demand for financings. And I would expect that the markets, both on equity and debt, but particularly on equity, would open up quite a bit. That gives companies currency, and that matters. Then finally, I think you see a balance between price expectations between a buyer and a seller, much more in line now than they were perhaps in the beginning of 2024.
Take us through that interest rate analysis, because I'm not sure that we always fully understand. There's a lot of debate, even just for next week, is it down by 25 or by 50 basis points, but more debate about where does the Fed end up, with some people thinking it'll end up higher than what the markets think right now, that it's not going to be able to bring it down as much. How important is that in making decisions about making deals, whether we end up at 4.25 or 3.5, for example?
Great question. I think it is so much less important than people ascribe to it. The CEO doesn't look at his or her balance sheet and says, wow, if I can finance at 3.5% versus 3.75%, I'll do the transaction. You're making a long-term strategic decision. Therefore, what you're trying to do is say, what will long-term the impact of the economy, the impact of the rate environment mean to me? And when you see the curve decline, it increases confidence, increases optimism, and that's the difference. I'm always struck by how people are focused on what will happen over the next 3 months in determining how they want to make trades. I understand for certain traders, great, but for my world, where you're talking about businesses, talking about companies, they just don't have that mindset. They're looking at the overall economic picture generally, of which the rate environment is one part of it.
If there is a pent-up demand for deals that's sort of being held off for both when the Fed starts really cutting and where it's going, and for the elections, where do you see particular demand that is pent up? I mean, where are there transformational areas? I mean, certainly we cover media a lot, for example. There's a lot in tech. Where do you see sectors that particularly might be ripe for deals? So
I think actually most sectors. There's been in most of these sectors, David, a couple of big deals already. So talk about media. Paramount, obviously a big deal. It's a sector that is entirely under disruption. You should assume we will see more. Consumer, you already saw a big deal, Kellanova Mars. I assume that will lead other companies to think about what they want to do. Tech, in there you have finally, I think, a calibration and equalization between buyer expectations and seller expectations. You'll see more there. Healthcare has been busy throughout. No reason to think it won't continue to be busy. So I would actually argue it's not going to be, from my perspective, just 1 or 2 sectors. I think there'll be a general lifting of the market. And to me, that means a good market in our world now is 5 trillion or above, but a perfectly fine market is 3.5 trillion to 4 trillion. It's hard to imagine that we don't have at least a perfectly fine market in 2025.
Has the deal area been held back a bit by private equity actually retrenching? There's a lot of talk about private equity. What's happened because of interest rate hikes, we've seen some institutional investors actually recalibrate how much they put into private equity. Is that less of a factor for you than it was a year, 5 years ago?
Absolutely. I think the private equity community is 35–40% of the overall market in a good year. I'd be surprised if in 2025 you don't see that part of the market being very active, very robust.
And are corporations stepping into that to do their own deals, not through
corporations are already you're seeing a lot of corporate activity already, and I don't in any way think that's going to slow down. Remember, the market Ps are down 2.5 points from the peak a couple of years ago, and earnings are still pretty good. S&P 500 earnings for this year and for the next quarter will, again, 80% of the companies will outperform estimates. CEOs feel this kind of tailwind, and my bet is that they will invest against it.
You mentioned regulatory issues, uncertainty over regulatory issues. We are back to the election then when it comes to regulation. We're pretty clear, I think the markets believe, that Donald Trump, if he is reelected, will really pull back on some of the antitrust competition enforcement. Do we have a sense on the other side? Do we think that it's likely to be easier than it was under Biden no matter which way it goes?
So again, if you actually look at the facts, and that's what I'm supposed to do in my job, under the Biden administration and under the Trump administration, the regulatory for antitrust has been the same. In both administrations, 2% of all deals got a second request, and in both administrations, 8 or 9 transactions were challenged in the courts. Okay, I think under a Harris administration, you will see continued focus on competition, on fairness, on consumer impact. That's what you're going to get. But that does not in any way mean you can't put together a transaction that is pro-growth, pro-consumer, and able to pass muster, therefore, with the regulators.
One last question, Blair. I'm curious, if you look back over, I'll say 5 years, what's the biggest change in your business?
The biggest change in my business is the ease of information and processing information, which has led to even more importance on judgment. What do you do with the information? But boy, we're getting a lot of it, and I'm still trying to figure out what to do with myself.